Welcome to the February 2026 edition of the ClearVista Financial Perspectives. I'm Mark Trice, lead advisor here at ClearVista Financial, and we do appreciate you taking time to join us today for this monthly event. As always, we're all keeping a close eye on what's happening in the markets and the economy, and we'll also walk through what this means for you and your investments, your financial plan, your peace of mind. A lot of stuff going on in January. Let's jump right into the market recap. So in the month of January, things were steady. We had the S&P up by 1.37%. The NASDAQ struggled just a little bit compared to other stocks, and we'll get into that in just a moment. There's more to that drawback, if you will. Dow Jones up 1.72%. Long-term treasuries are flat to slightly negative. And then the moderate 60/40 allocation we sometimes use as a benchmark was up 1.47%. And small caps had a nice little gain there of about 1.37%. As always, I have to have you memorize this disclosure. We want to make sure that you realize that these are just indices. They are not investments that you can actually put money into. So where are we kind of in the seasonality for volatility with the S&P 500? Well, January typically is a little bit higher volatile month. We did have a few days in there that was actually a little bit more volatile than normal, but February tends to be a little bit of a cool period historically. That does not mean anything as far as what will actually happen. In fact, if you can see on this chart, that volatility typically starts to increase towards the end of the month of February. Increases quite a bit through March and April. That's just a historical number, so we don't want to put anything into that. But with all the things that are going on in the world right now, I would expect a little bit more volatility. All right, so let's go into a little bit of an economic update. Remember, you can text us 254-282-0495. So a lot of news from last month. Number one, the Federal Reserve chose not to lower rates or raise rates, and so they noted it was a little bit more stable, more confident, and growth was upgraded a little bit. The officials of the Federal Reserve kind of viewed it as roughly neutral as far as the economy. There were two Federal Reserve presidents that voted in dissent. They wanted to cut rates. The rest of them did not. The big during the Q&A session, the press conference, the big thing that was really asked of Chairman Powell was, what does he think about Trump? And of course, he wouldn't bite on that particular question. Later in that same week, President Trump announced that he would nominate Kevin Warsh. Kevin Warsh is a former Fed president, regional Fed president in the past, and he has been quite vocal that the Federal Reserve is not doing enough. But the notion to keep rates level with this meeting is kind of showing that there's some tension between the cooling job market and inflation. And so they chose not to raise rate or lower rates, to wait and see what happens with inflation. Let the data do its job. Remember, the Federal Reserve has two mandates. It's to keep unemployment steady or employment steady and to keep inflation in check. And still coming out of the 2022 high and 2023 high inflation years, inflation has cooled just a little bit. We'll talk about that in just a second. Yield curve, we always show this. This was a lot more important, I think, during COVID and the mild, I'm going to call it a recession, even though technically it was not. But it was a mild slowing of growth, if you will, during the COVID 22-23 timeframe. This is what a normal yield curve typically looks like, where you have short-term rates on the left-hand side lower than long-term rates on the right side. So everything's looking okay there, better. We did not have the recessionary period follow an inversion in the yield curve like typically has happened. Just data is a little bit different. Our economy functions a little bit differently than it has in the past. So let's look at the consumer price index. Now, everything is still behind when it comes to government data. So in December, because that 41-day shutdown or 49 days, I can't remember exactly, shutdown put everything behind. And even the government shutdown of a couple of days this last week already had the Department of Labor saying that it would be longer for getting data out. So we may be a little while before we see the January numbers, but the consumer price index in December was actually right on schedule. The core CPI was only up 0.2% in December. That was below expectations, and that's up 2.6% year over year, much lower than we've seen in the 3.5 inflationary period year over year with core inflation. Food and energy did go up quite a bit. Real wages were relatively flat in December, only up 1.1% year over year. That should slow spending, but the real number that we like to look at when it comes to inflation is really the money supply, or M2. And that's been really muted over the last 3 years. And we expect that inflation will continue easing. So it's exactly what played out in 2025, despite the threats of tariffs and all those different things around. Tariffs really doesn't drive overall inflation. We just think it has to do more with how much money is in our economic system. So both the headline and the core inflation finished 2025 lower than in 2024, despite, all sorts of bad news about a potential resurgence of inflation. The producer price index, this is a key with producer prices. The trend is over noise. One strong month doesn't change direction. So December's 0.5% PPI increase looks large, but year over year, inflation slowed to 3% with producers, down from 3.5% in 2024. The jump in December was really concentrated, over 40% of it driven by a spike in machinery equipment wholesaling margins. These margins are not really persistent. Historically, smaller spikes have been followed by pullbacks, or similar spikes have been followed by pullbacks. And so despite those tariff concerns that we saw last spring, goods prices remained restrained, rising just 2.5% in 2025 and really flat in December. Employment, we're behind a little bit. We should have had employment now. We may get a report tomorrow. ADP has put out some things already, but we'll talk about it in a second. So payroll growth in December was up 50,000 jobs. That was below expectations, and they revised prior months downward. Private payrolls were up 37,000 employees. That momentum is beginning to fade. And the growth was really modest, and those downward revisions matter more than the headline does. For all of 2025, job growth averaged just under 50,000 new jobs every month, with the private sector gains being even softer. So employers are remaining cautious in kind of a low hire, low fire environment, holding on to workers but not expanding. There's also the influence of artificial intelligence that we'll talk about in just a moment. So all in all, okay jobs report, but nothing really on fire. ADP, which is the payroll provider, did release some numbers here, and it was basically saying that January hiring was only up 20,000. I think we typically see a little bit of a slowing down in January anyway, after the post-Christmas time frame and stuff. Unemployment in December was a little bit lower than November, but it was higher than a year ago. So not a trend yet. We'll have to see how those numbers continue, and once we get them from the government here real soon. So let's talk about GDP. We only have third quarter data, but real GDP growth was revised higher to 4.4% annualized. and that exceeded expectations by a lot. The gains were driven by the consumers. We're still spending a lot of money, and that really is impacting growth overall. So consumer spending, net exports, we're exporting more, and that pace is very close to the pre-COVID trend, suggesting the economy is normalizing, not overheating. Well, hey, housing remained a drag, as it has been, but business investment improves. And corporate profits were a bright spot. They showed solid quarterly and year over year growth. So those are all good signs. What about manufacturing? Well, the ISM manufacturing index rose to 50.2% or 52.6% in January. That suggests, and anything above 50 it suggests an expansion. This is the first sustained move above 50 in a year, which is encouraging. But like I said before, with inflation and employment, one month doesn't make a trend. Growth in January was uneven. About half of manufacturing industries expanded while others are still contracting. The biggest positive in this was new orders, which jumped sharply and growing at the fastest pace in quite a few years. So, online order backlogs turned positive after 3 years of decline, and that helps support production. So those are all good things. That's just a little bit about the economy. There was a lot of stuff going on this last month. We had threats of invading Greenland. President Trump was very terse, if you will, at Davos. We've had all sorts of different unrest and political unrest in some of our cities. So lots of things going on there. Now, in the last week or so, technology has begun to have, especially software companies have begun to have a little bit of a sell-off, quite a significant sell-off. And the fear, which is what drives most market movements, it seems, the fear is that artificial intelligence will basically do away with the need for software companies. I can see this in some extent. I can understand the argument that AI can have an impact on that, but I think what we've seen, at least in other industries, is artificial intelligence only enhances our abilities to write code and software and develop software. Even in our own office, we're using our artificial intelligence just to improve our processes. It does not replace anything as far as your financial planning. You still need to talk to an advisor if you're nervous about things. Don't panic, though. Investing in financial planning is a long-term game. We're in the season of the Olympics. It's the Winter Olympics. Not my favorite. I prefer the Summer Olympics, but it's a long-term goal. Some of the events are very, very long and intense. I'm thinking of the biathlon, and that's where they're skiing and shooting, and it's a long event. And so we should avoid decisions driven by headlines. I've been getting a lot of calls about gold and silver and things. Only, gold hit an all-time high above $5,000 an ounce, and then quickly sold off 16 to 20% in the next week. So very volatile stuff. Don't make decisions based on what you're reading in the headlines or hearing on the radio or watching late night television. Make sure that you're staying informed. Read the news, but ask questions. In fact, question everything, because there's a lot of bad advice out there on social media. And it's usually with people, either it's artificial intelligence that's putting it out there, or someone's using AI and they're not checking the facts. And so I encourage you to educate yourself, learn what's going on, don't panic, ask questions of your advisor, and make sure that they're adapting to the quickly changing environment in our economy, in our markets, et cetera. So if you have questions about your retirement plan at work, a lot of people believe that their retirement plan is just being managed by their employer. And the reality is it's not. You need to take charge of that. There are ways that you can better manage your 401k plan or other retirement plan at work. but you need some guidance. And so we've got resources to help you with that. You can give us a call if you like and talk about that. We've got some tools that we've been rolling out the last 2 years to help you make a determination based on your risk profile, your tolerance, your financial goals, what you should invest in. I know the 401k companies try to do a good job to educate you, but they're not doing very well about how you should be managing your investments. Okay, so what does this all mean? We want to make sure that you are talking to someone about your financial plan. If you have not created a financial plan or updated it recently, you need to talk to a professional. I can't stress that so much. The big thing that we see impacting retirees or soon to be retirees or people that just want to retire in general is taxes. Taxes are complicated and they can really make a huge difference in whether or not you have success in your financial journey or less success. Just make sure that you're always asking questions. We think that the market will continue strong. The NASDAQ this last month, it has not reached a new high since, I think, November. So that's struggling. Some people believe that the artificial intelligence market is a little bit overheated. But folks, things really go down to the fundamentals. Is a company making money for their shareholders? How are they making that money? And can that be sustained? These are all questions we've always asked about markets. And so I encourage you to do the same. Just make sure that you're getting a second opinion and always talking to your financial advisor. So I don't see any questions or anything on the chat room, but you can send us a text anytime at 254-282-0495. Or always visit us on the web at clearvistafinancial.com. We've got so many resources. This video will be posted on our YouTube channel. You can access them through our website. We've got lots of other podcasts that you can listen to or watch. And as always, if you're not a client of ours, you can request a complimentary consultation. We'll take a look and see how you stand. We'll ask questions about your taxes. We'll ask questions about your investments. And at the very minimum, you can take those questions back to your current advisor, or you might decide that we might like to work with you. So we offer that complimentary consultation. Just send us a message at one of these forums here, 254-282-0495. You can text us. And as always, folks, we thank you for listening to this month's broadcast. You've been listening to ClearVista Financial Perspectives. Thanks so much.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.